Hi, it's Michael Farr from Farr, Miller and Washington. It's been a volatile week so far for stocks. Chairman Bernanke was testifying and indicated that he felt that the economy was still somewhat weak, that the recovery was still in a fledgling stage, and markets liked that. They liked it a lot. It sounded like there was still going to be some sort of accommodation coming from the Fed if conditions warranted it. The promise of more Fed cash took shares higher on Monday. That's been in keeping with a Farr-Miller theme you've heard me talk about and write about for quite a while. As long as the Fed's there promising cash or actually delivering cash, share prices have gone higher. That in many ways means that the risk trade was back on. We did see a shift in 2011 where blue chips and more solid balance sheets were actually getting to perform better. The Dow Jones Industrial Average actually began to outpace the Russell 2000 by a pretty good margin, indicating that those big blue chips were beginning to come into their own. That's reversed a little bit in the first quarter of 2012, but not quite decisively, and I think that those multinational blue chips still represent value. So as I mentioned in the USA Today article this week, as long as Bernanke continues to promise a punch bowl filled with cash, share prices are going to go higher. On CNBC this week, I talked with the Squawk on the Street gang of Carl Quintanilla and David Faber about dividend-paying stocks. We have a lot of those stocks in our portfolios, and we think that certainly now is a pretty good time to own them. Portfolios, I think, have been holding up very nicely. So we continue for clients with accounts under our management to buy and invest in those companies. I think as we look ahead, we expect continued push-pull and volatility, not only from comments out of the Fed, but over the next week, probably the Supreme Court will do more regarding health care, and the health care debate will do more to affect markets in the short-term swings. So I think in terms of an investment strategy, conservatism, solid balance sheets, and not a lot of trading make most sense. One of the old lines in the bond business was, if you can't be right, be liquid. That's certainly true when we select companies' balance sheets. We like lots of cash. We don't like a lot of debt. So those are things we're looking at Farr, Miller and Washington. Keep your powder dry. We're going to get through. I'll talk to you next week. For Farr, Miller and Washington, I'm Michael Farr.